Trump nominates Kevin Warsh to lead Federal Reserve and eyes monetary regime change. The Eurozone economy grows 0.3% in Q4. Annual growth hits 1.3%. And Indonesia's financial regulator chief resigns after $80 billion market sell-off. Hello there, good evening and welcome to the Qnews Economic Bulletin tonight. And we start off with the United States, where the Labour Department has reported that producer prices jumped 0.5% in December, more than double the 0.2% forecast, as businesses passed on higher costs from import tariffs. Over the year, the producer price index rose 3%, unchanged from November. The increase was driven mainly by services, including 1.7% rise in wholesale and retail trade margins, while producer goods prices remained flat. Economists said that the data suggests inflation could accelerate in the coming months, despite the Federal Reserve holding interest rates steady. The Labour Department has reported that the number of Americans filing new applications for unemployment benefits fell slightly last week, still consistent with a relatively low level of layoffs, though lackluster hiring is stoking anxiety among households over the labour market. Initial claims for state unemployment benefits dropped 1,000 to a seasonally adjusted 209,000 for the week ending January 24th. Data also showed that the number of people receiving unemployment benefits after an initial week of aid, a proxy for hiring, decreased 38,000 to a seasonally adjusted 1.827 million during the week ending January 17th. The United States has signed two separate reciprocal trade agreements with El Salvador and Guatemala. El Salvador is the first country in the Western Hemisphere to finalize a deal under President Trump's new trade framework. The agreement eases Salvadorian restrictions on U.S. agricultural imports, including cheese and meat, while the U.S. will lift tariffs on certain Salvadoran goods, such as clothing. The agreement with Guatemala, signed by the U.S. Trade Representative Jameson Greer, targets trade barriers for American workers, expands markets for U.S. goods, and reinforces strategic economic ties across the Western Hemisphere. President Trump has threatened to hit Canadian aircraft with a 50% tariff unless Canada certifies U.S.-made Gulfstream business jets. Trump says Canada has refused to approve models including the Gulfstream 500, 600, 700 and 800. In a social media post, he warned that all Canadian-made planes, including Bombardier jets, would be decertified until the U.S. planes are fully approved. Now to the big economic story of the day. President Donald Trump has nominated former Federal Reserve Governor Kevin Warsh to lead the U.S. Central Bank when Jerome Powell's term ends in May, giving Warsh a chance to implement his vision of monetary policy, regime change. Trump praised Warsh as a great Fed chairman and said he would never disappoint, while the appointment requires Senate confirmation. The move comes amid Trump's frequent criticism of the Fed and efforts to influence its independence, including a Justice Department probe into Powell, raising the prospect of a contentious confirmation process and uncertainty over Powell's possible decision to stay on. And we couldn't have a better guest to discuss this story with us. We are joined from Washington by founder and chairman of Links Investment Advisory, Peter Tonos. Thank you very much for joining us here on Q News. So Kevin Warsh's nomination, what do you make of him? And what do you think this tells us about President Trump's priorities for the Fed?
Well, it's a pleasure to be with you again, Mark. Warsh is actually a very good candidate, a very qualified candidate from every point of view. He has served on the Fed board for 5 years, from 2006 to 2011. His philosophy is somewhat hawkish, meaning that he is worried about inflation. Well, if you're worried about inflation, you take a dim view of lowering interest rates, which is a little bit paradoxical given what Trump wants him to do. I think it's important to keep in mind that the Federal Reserve sets interest rates by a vote of the 12 members of the Federal Open Market Committee of the Fed. Now, historically, the chairman has driven these discussions to get a unanimous decision by the board. And that was the case until recently. And that may not be the case going forward, but it is still a vote of the 12 members. So bottom line to your question is, I don't think the market is going to be overly concerned about this appointment.
Yeah, it seems like a bit of a weird one because Trump's main criticism of Jerome Powell is that he wouldn't reduce interest rates as Trump wanted him to. And Warsh, by all accounts, is not somebody who's going to be reducing interest rates either. So what attracted Trump to him, do you think? I know Warsh has been critical of the Fed in the past. Is that maybe what Trump liked about him?
Yeah, no, that's of course the question of the day. That's the great question, Mark. And I think the answer is that Warsh probably would have voted for a decrease in interest rates at the last meeting, and I suspect he probably told that to Trump. But that doesn't tell us anything about how he will govern in the future. He will, like most other Fed members, rely on data. You've heard this expression countless times. The decision is data dependent. What does the data tell us about the economy going forward? The Fed was reluctant to lower interest rates at the meeting yesterday or a couple of days ago for the simple reason that the economy is strong. Unemployment is stable, and we're concerned that lowering interest rates may exacerbate inflation because inflation is still a bit higher than everybody wants it to be. So that's pretty much where we are. It's not likely that Warsh is going to deviate a whole lot from this consensus.
And do you think he's going to be, if he gets a confirmation by the Senate, do you think he would be the kind of leader of the Fed that would resist any political pressure from the White House and try to maintain the independence and credibility of the Federal Reserve?
Yes, I think so. It's not likely that he'll take orders from the White House. Now, it is possible that he may agree with the president on certain aspects of the economy and whether or not interest rates should be lowered, which of course is what the president wants. The consensus today is that we may have one reduction in interest rates this year, not two or three, as many had hoped and perhaps the president had hoped. That is not likely to change. The confirmation hearings will be interesting, not so much for the result, because it's pretty certain he'll be confirmed, but for the questions that will be asked of him about his independence. So that'll be interesting to watch.
And do you think he might? What kind of impact would you think he might have on the economy? Would it be a different regime? And of course, he will be the most powerful man when it comes to the global the global economy. What kind of impact do you think you'll have?
Yeah, I don't think that what we're worried about and what the sense of your question is whether or not he's going to be taking orders from the White House. I don't think that's going to be the case. And again, remember, 12 voting members and a consensus needed to make changes in interest rates one way or the other. So I think the world will not be disappointed in either his appointment or how he behaves once on the job, because I think the independence of the Fed is not really a major issue to worry about at this point.
Of course, Trump nominated Jerome Powell, the current head of the Fed, and now he's been investigated by the Department of Justice. Just a few minutes ago, the Department of Justice gave a press conference in which they were asked whether they would drop the charges against Jerome Powell now that Trump has nominated a new leader. And the Department of Justice said these two things aren't connected. It's going to be a difficult few months for Jerome Powell, is it not?
I don't think so. The charges brought against Chairman Powell were extremely ill-advised. Most intelligent observers, including friends of the president, think this was not a very good idea. My own view is that this is going to fade away into the background, as many of Trump's more unpopular decisions and dictates do. What happens is he'll make a statement like that, like, he's bringing charges against Chairman Powell, and then we tend not to hear about them a whole lot anymore. They kind of fade into the background when he realizes it was probably not a very wise decision to start with.
And of course, it's something Kevin Warsh can look forward to in the future, perhaps. How does this nomination, do you think, compare to Fed transitions under other presidents? Is this a pretty stable transition, a good appointment, as you said, and pretty much like any other president would have done?
Yeah, no, it's different because remember, Trump wanted the Fed to do pretty much what he told them to do, which of course scares the hell out of every major institution and most foreign governments and central bankers. That's the last thing they want to see happen. So this time is different because of the circumstances surrounding the appointment of Kevin Warsh. It's different because everybody knows that the president wanted to appoint somebody who would pretty much do what he tells them. It appears, given Warsh's background and history, that is not likely to happen. And keep in mind, and this is also very interesting, Mark, Jay Powell's going to be there until May, and he may stay on as a governor if he chooses to. So his influence will remain. The good news, as I mentioned earlier, is that given Warsh's background, it is not likely that he will be viewed as somebody who's going to take orders from the White House. Although he might occasionally agree with the president, he's not going to be taking directive from the White House. And also keep in mind, 12 votes needed to make changes in interest rates.
Well, thank you very much from a very cold and very snowy Washington. Thank you very much, founder and chairman of Links Investment Advisory, Peter Qnews. Thank you very much indeed. Now let's get the latest economic news from the rest of the world. Eurostat has reported that the Eurozone economy grew 0.3% in the fourth quarter of 2025, with annual growth at 1.3%. Strong consumption and investment offset weak exports and trade uncertainties stemming from the US tariffs and global competition. Spain led the bloc's expansion with 0.8% growth, while Germany and Italy each grew 0.3%. Economic indicators point to a solid start to 2026, supported by stabilizing industry, resilient domestic demand, low unemployment, and steady inflation near the ECB's 2% target. As for France, INSEE has reported that the economy expanded 0.2% in the fourth quarter of 2025, slowing from 0.5% in the third quarter. Modest growth was driven by household spending and investment, while a drawdown in corporate inventories weighed on activity for the full year. The economy grew 0.9%, above the 0.7% forecast in the government budget planning. Economists said political uncertainty and a strong euro may limit a robust rebound in 2026, though early signs of improving business confidence provide a cautiously positive outlook. Now, Germany's unemployment has risen above 3 million for the first time in 12 years in January, reaching 3.08 million despite stronger than expected economic growth. Labour Office data showed 117,000 more people out of work than in December, lifting the unadjusted jobless rate to 6.6%. While Chancellor Friedrich Merz has promised higher infrastructure and defence spending to revive the economy, Labour officials say the jobs market remains weak. On a seasonally adjusted basis, unemployment was unchanged at 2.976 million, with the jobless rate steady at 6.3%. And from Washington to London now, we're joined by political and economic analyst Babak Imamian. Thank you very much for being here with us on Qnews. Eurozone GDP grew 0.3% in quarter four 2025. Spain leading the bloc, as we were saying. So, what factors do you think helped the region maintain growth despite its weak exports?
Well, I'm sorry that we get excited about these low growth economy. For example, the projection was the entire Eurozone would economic growth would be 0.9%. Now it is 1.3%. So we ought to celebrate. I think it's totally a wrong attitude. Low growth economy is the biggest threat to Europe right now. And right now, the Europeans have lost the expertise in growing their economy. You go back after the World War II with people like Ludwig Erhard, 1948, who started the miracle of German economy. And then later on in 1990, the reunification of East Germany into West Germany. All these were major issues, but it was well handled and Europe knew how to grow its economy. Right now, the only people who know how to grow their economy are the USA and the Chinese. Otherwise, Europeans lack the ability and they don't want to change. They do not want to change the ways they are doing their business or politics in order to grow the economy. I think there is that issue, that mental blockage of not wanting to adopt new ways to grow the economy is the biggest threat to European economy right now.
So is there anyone in Europe who shows any signs, any nation, any people in Brussels who show any sign of wanting to change in order to get that economic growth?
Well, the first thing, for example, if you are a president or prime minister of a country, the first thing you would want to do, for example, I'm actually mentioning yourself, would be to lower the cost of energy. And right now, the only country who has lowered the cost of energy is Spain. But this is because they have a lot of solar energy because of geography, the way they can access lots of sunlight. So that's one. That's the reason why the Spanish economy is doing much better than the others. But right now, the problem we have is high cost of energy, and there is no policy. We have no energy policy. Also, the Ukraine war, which is a drain on the economy. So there is no clear geopolitics for Europe, what they want to do in order of the relationship. They can't even maintain a peace in Europe. If you go back since 1945, it was every time it was the Americans who actually intervened to keep the peace in Europe. Otherwise, on their own, they cannot able to do that, and they're not addressing those issues. And there are also a high cost of labor. There is the issue of high regulation, high taxation, net zero green policy, which then again, they don't want to change. So we have all those problems, and yet they don't want to address it.
Now, Germany's unemployment, as I was saying just there, rose above 3 million for the first time in 12 years. This is a bit of a disaster for Germany, isn't it?
It is, because Germany right now suffers from, and I'm saying this carefully, too low inflation. Inflation in Germany should be up to 4%. For whole European project of keeping inflation target at 2%, it does nothing but to crash the economy. When you have an economy which is indebted, it has so much debt, you want high inflation. In terms of, by high inflation, I don't mean hyperinflation, but I mean 46% inflation, where actually the debt is depreciated. And more importantly, as a businessman, there is that expression that we use a lot, that we say the inflation will carry me through. The idea is when you run a business, it is high risk, and occasionally you make mistakes. And then you need an invisible hand to help you out. Usually that invisible hand would be inflation of 4 to 6% that would carry you through. But since 1998, where they have adopted that 2% target inflation, that has damaged the European economy across the board, while Chinese are not following that. And the Americans, in their own way, they never follow that. They talk about 2% inflation, but if you take it sector by sector, that's not the case.
Chancellor Merz, just staying with Germany for a second, has promised higher infrastructure spending, more defense spending. Is that going to help? Is that going to impact the jobs market? Is that going to create any kind of growth?
So what is happening is Germany is switching from consumer product economy to war economy. Is that a good thing? Of course, it's not a good thing. And is that the best they can do? They never had to do that in 1948. They never had to do that in 1990. Why do they have to do it in 2025 and 2026? The reason is because we have incompetent politicians who have no clue about economy and no clue about history. It is all in the books. All they have to do is refer to the books and find the solutions.
And other risks that global trade tensions or like the rising unemployment in countries could slow the Eurozone growth in the coming months?
Europe as a whole is a very talented continent. It's been a continent of inventions, and what it needs is opportunity to grow its economy. But when you have over-regulation, high taxation, it is not possible to actually small businesses to grow. And I'm going to use this phrase, unholy alliance. Right now, there is that unholy alliance between the treasuries, the tax collectors, the corporations, and the trade unions. They all want to have a much smaller small business sector and medium-sized sector. They all want that. The treasury wants only corporates because it is much easier for treasuries, for the tax collectors to collect taxes from corporations rather than many small businesses. Corporations, they don't want competition from small businesses, so they just love to monopolize the economy and get rid of small businesses and competition from them. And thirdly, the trade unions. Trade unions, they love corporations because they can increase their membership through corporations. It is very difficult for them to attract membership from small businesses, but it's much easier to have. So you have that unholy alliances between the corporates, trade unions, and the tax collectors, the treasuries. And nobody in Europe is addressing that issue.
Well, thank you very much. It's always great to have your thoughts. Lovely to see you again from London. Political and economic analyst Babak Mamian. Thank you very much indeed. Now, on intercontinental relations, Chinese Premier Li Qiang has called on China and Britain to strengthen cooperation and carry forward the ice-breaking spirit at the 2026 UK-China Business Council meeting. He highlighted opportunities in trade, innovation, clean energy, AI and people-to-people exchanges, noting China's resilient economy under its 15th five-year plan. British Prime Minister Keir Starmer, who's currently in China, said his visit is aimed to better understand China and seize opportunities to benefit the UK economy, encouraging closer business dialogue between the two countries. Whilst on his visit, the British Prime Minister, Sir Keir Starmer, said the United Kingdom should not ignore China, brushing aside US President Donald Trump's warning over closer ties with Beijing. Starmer's China's visit delivered agreements to cut tariffs on UK whiskey, ease visa rules and improve market access as his government seeks to boost growth. He said Britain's relationship with the US remained close and that London did not need to choose between Washington and Beijing.
It would be foolhardy to simply say we'll ignore. And you know, the French president has visited and engaged. The German Chancellor is coming to visit and to engage. For the UK to be the only country that refuses to engage would be not in our national interest.
Prime Minister Starmer there in China. Now, the Finance Ministry has reported that China's fiscal revenue dropped 1.7% in 2025 to 21.6 trillion yuan, marking the first contraction since 2020, amid a weak property sector and sluggish domestic demand. Expenditures rose just 1% to 28.7 trillion yuan, slowing from 3.6% growth in 2024. Tax revenue grew 0.8%, while non-tax income fell 11.3%, with land sale proceeds declining for a fourth consecutive year. Despite the fiscal shortfall, the economy grew 5%, meeting government targets, and officials pledged continued proactive fiscal measures to support growth in 2026. The chief of Indonesia's financial regulator, Mahendra Siregar, and several senior officials have resigned, citing moral responsibility following a massive $80 billion market sell-off this week. The resignations came a day after the head of the IDX stock exchange also stepped down after a market rout triggered by MSCI warning of a possible downgrade over transparency concerns. The Financial Services Authority, OJK, said the resignations would not affect the regulator's ongoing duties or recovery efforts. And for his part, Indonesia's chief economic minister, Erlangga Hartarto, has promised greater stock market transparency and improved corporate governance following the resignation of Indonesia's stock exchange CEO, Iman Rahman, after a $80 billion share sell-off. Hartarto outlined measures including doubling the free float requirement to 15%, allowing pension and insurance funds to increase capital market investments, and tightening rules on small shareholder affiliations. The market turmoil was triggered by MSCI warning of a possible downgrade of Indonesian stocks due to transparency concerns. Now, in North America, Statistics Canada has reported that Canada's economy was flat in November, as gains in services were offset by weakness in goods-producing industries analysts had expected modest growth of 0.1%. Services such as retail trade, transportation and education drove growth, but manufacturing contracted 1.3%, hit by US tariffs and global semiconductor shortages. Wholesale trade in agriculture also declined. Preliminary data suggest a slight 0.1% increase in December, but November's figures point to a possible 0.5% contraction in the fourth quarter, raising concerns about a potential technical recession. And gold prices fell as much as 8% on Friday to briefly dip below the $5,000 per ounce mark as the dollar firmed following President Trump's announcement of his choice for the Federal Reserve chair, even as bullion was set for its strongest monthly gain since 1982. Spot gold dropped 5.8% to $5,081.52 per ounce after retreating to an intraday low of $4,957.53 earlier. US gold futures for February delivery slipped 4.1% to $5,079.60. The sell-off, described by analysts as profit-taking, also pressured other precious metals. Among other precious metals, spot silver was down 13.9% at $99.94 an ounce after dropping as low as $95.79. Now that almost is all we have time for on our economic bulletin, but if you just joined us, here's what you've missed. Trump nominates Kevin Warsh to lead Federal Reserve and eyes monetary regime change. Eurozone economy grows 0.3% in quarter four. Annual growth hits 1.3%. And Indonesia's financial regulator chief resigns after $80 billion market sell-off. And that's our economic news roundup. Thank you for joining us. Stay informed, stay ahead. Don't forget you can follow us 24 hours a day on our social media platforms. Our handle at Qnews EGY. Thanks for watching. Good night.